Hello, my name is Mike Molina, and I'm a senior loan officer with the Molina Group at Intercap Lending. Today, I want to talk to you about an exciting program called the Buy Before You Sell Platinum Program with Intercap Lending. What it does is it allows a seller to buy a home without selling their old home. So perhaps the situation sounds familiar to you. You're a homeowner and you want to buy a new home, but you don't feel like you can do that because you need to sell your old home first. And it's not practical or financially feasible to sell your home before buying your new home. So what do you do? Well, there are several traditional options that you could do. You can try to do a concurrent closing where you buy and sell your old home at the exact same time, but that's pretty hard to navigate and set up. There's contingent offers, but that creates a real problem because most sellers today don't want to take an offer from a buyer when it's dependent on whether or not they can sell their current residence. There's bridge loans, but those are very expensive. You can do a home equity line of credit on your current home to buy the new home, but then you have to qualify for all the mortgages on both homes, and that can be difficult for a lot of people. And then there's iBuyer programs. I'm not going to go into that other than to say they used to serve a practical purpose, but they are very expensive, and sellers tend to lose a lot of their net profits in the process. So what's the solution? So our Intercap Buy Before You Sell Platinum program allows you to exclude the departing resident's mortgage payments from your debt to income ratios when qualifying for a purchase loan to buy a new home. There are no special property restrictions on neither the departing residence nor the new home you want to purchase. You can also, if you wish or need to, get a home equity line of credit on your departing residence to use in the purchase transaction of the new home without including that payment in the debt to income ratio when qualifying for the loan for the new home purchase. And you can use those funds for whatever you want: down payment, closing costs, paying off debt to qualify more, reserves, whatever. There's no additional fees than you would otherwise pay for any other purchase loan when using this program. There's no additional pre-approval required, and there's no property type restrictions of any kind. So what are the requirements? Well, first of all, it has to be a primary residence to primary residence transaction. You have to be departing your primary residence, and you have to be buying your new primary residence. This program is only available for conventional and jumbo loans, no government loans of any kind. The maximum combined loan to value of all the liens or mortgages against your departing primary residence cannot be greater than 80% of the value. You must have reserves that will be available after closing on the purchase of the new home equal to 12 months of the principal, interest, taxes, and insurance and HOA fee, if applicable, of payments for all mortgages or liens against the departing residence. So, for example, if the combined payments for the first mortgage, perhaps a new home equity line of credit, and the HOA fee were $1,000 per month on the departing residence, then you would need $12,000 of reserves available after you close on the purchase of the new home so that you have that as a cushion while you sell your departing primary residence. The key requirement in this transaction that makes it different from all others is that all you have to do is provide a letter of intent that you will list your departing residence home within 90 days of closing on the purchase of your new home. The minimum down payment for this program is 10% with a 740 or greater FICO score. If you have less than a 740 or greater FICO score, then a slightly higher down payment will be required. So that all sounds really exciting and really easy and really cheap. But what do you do once you sell your departing residence home and you have all this extra cash? So let's say, for example, that several months after buying your new home, you sell your old home. Now you have a big chunk of cash and you want to use it to pay down the principal balance of the loan you recently obtained to purchase your new home because you would like to lower your monthly payment. But if at that time, for whatever reason, refinancing doesn't make good financial sense, you can instead opt to recast your loan. What does that mean and how does it work? Well, all you do is first notify your current servicing lender that you want to make a large principal reduction payment and then recast your loan. As soon as you make the large principal reduction payment, then your loan will be re-amortized over however many months remain on your loan term. This will reduce the principal and interest portion of your monthly mortgage payment, and your overall mortgage payment will go down. So let's say, for example, that you got a 30-year mortgage when you bought your new home. It took 8 months to sell your old home, and you have $100,000 that you want to apply as a principal reduction payment to your current loan balance of $500,000 and recast. You make the $100,000 principal reduction payment, and your new loan balance of $400,000 is re-amortized over the remaining 352 months of your loan. That's it. It's that easy. There's no qualifying, there's no credit report needed, there's no job or income verification, and there's no assets other than the principal reduction payment required. There's a nominal processing fee of about $150 to $400, and that's it. So that's it. That's the overview of Intercap's Buy Before You Sell Platinum program and also recasting. If you have any questions, I'm more than happy to help you anytime. Please don't hesitate to reach out. Otherwise, thank you for watching. Have a wonderful day, and I hope to talk with you soon. Take care.